The next chapter we're going to cover for session number 2 is chapter 8, which relates to securities regulation. And you might ask, well, why is it that we're not a public company, but we have to learn about securities? It's because there are laws governing the sale of securities in the United States, and they actually do pertain to both public and private companies. So you really have to know what you're doing here because it could cost you delays in funding, it could cost you legal fees or further bad things down the road. So pay attention to how you offer equity ownership and the qualification of those investors that you've attracted. All right, so first we'll cover learning objective 1, which is what is a security? Number 2 is the purpose of the laws and why do we need them? I kind of gave you a little bit of hint. Third is to look at the risk and how the U.S. laws and agencies try to address these particular items. And a couple of hopefully humorous things on the bottom of the slide here. First is ignorance is no excuse. And this is true for many, many complex laws in the United States. Let's say that you're doing a tax return and you did it incorrectly and it resulted in a very low tax bill. The tax court and the Internal Revenue Service can call you in and you could be prosecuted. And you would say, oh, no, Your Honor, I don't understand tax law. I'm ignorant. Well, what the lawyer and the judge would tell you is ignorance is no excuse, and therefore you will lose your case. So the same holds, of course, for securities law. The other is, the comic is, there's no excuse, and then I didn't know that either. So again, you might try to fall on the pity of the judge, but it probably won't work. All right, so overview of the types of laws you'll encounter, and this is just an overview. There are far more laws and more detailed provisions than we'll cover. It's really beyond the scope of what we're trying to do. I'm just trying to raise awareness so that you know that there are laws that you need to pay attention to and time to hire an attorney to make sure you don't run afoul of some of these rules. So first, the objective is to regulate the offerings and the sale of securities. And this is the beginnings of how the laws evolved. There was a Great Depression in the 1930s, and that led to a stock market crash, or maybe it's the other way around. But the stock market crashed, and part of what happened was that people that were in the know were taking advantage of people that were not in the know. And so therefore, many of the members of the unsuspecting general public lost money. And so Congress started looking at this and came out with the first and major piece of legislation that is called the Securities Act of 1933. And that gave rise to much of the laws related to the regulation of the sale of securities in the United States. The next one is the Securities and Exchange Act of 1934. And this is more on the regulation side. So now that we have laws, who oversees that these laws are adhered to? And the answer is the SEC, you know, the SEC, Securities Exchange Commission. And this is the beginning of its existence. It was put in place by this particular piece of legislation. Third is you want to regulate investment companies that provide advice to clients, again, maybe unsuspecting clients. So here the Investment Company Act of 1940 regulated and created some structure and discipline in how advisors can work with clients to invest the client's money. Next is we want to regulate the advisors, including investment banking firms and their members. So this is the Investment Advisors Act of 1940, same time as the previous act, and it's really the other side of it. So we have companies, and now we have advisors within the companies. And finally, we want to look at the way to stimulate the initiation, growth, and development of a small business. This has always been a major priority in the United States. We tend to pay a lot of attention to the Fortune 500 companies, the high flyers, if you will, but the core of the economy in the United States has always been small and private companies. So the Jumpstart Business Startups in 2012 was an example of trying to, yet again, provide more incentive for the formation of company. And this included provisions for crowdfunding, which before was highly regulated or not regulated well, and very small in terms of dollar raised. All right, learning objective 1, what is a security? It's a contract for financing, and it could be any kind of financing. So most people think securities are only equity. That's not true. There are equity securities and there are debt securities. So it could be borrowing, such as a loan, a debenture, which is just an old-fashioned legal word for a bond, and a bond, right? The indenture agreement accompanies the bond. Equity could be common stock and preferred stock. In your corporate finance classes, you probably spent most of your time on common stock, but what we're going to do in this course is we'll touch on common stock, but the preferred method of funding equity from professional investors is preferred, and that's not why it's called preferred stock. It is both preferred by the investors, but the preferences are the power that they have over the common shareholders. That's why it's so important. And options are actually contracts and they're financings of sort. So they look at the rise in value or decline in value based on some underlying asset that they're tied to. The option could be related to a stock option, the stock price, or options can also be on commodities. So the field of options is very broad and very powerful, often kind of misunderstood, but options are financial contracts. And then finally, derivatives. Derivatives are securities whose prices are determined by some underlying asset. And so a derivative could be for corn futures or for steel prices, or could be even financial assets like the price and purchasing of the Japanese yen in the future, or the S&P 500 index. So derivatives are a very broad set of assets, which could be physical, like commodities, or could be financial, like S&P, or could be even inflation. So it's left to the imagination of finance people and investment bankers, and I hope you know this, but they actually are very imaginative, sometimes to their detriment. But derivatives are therefore a little bit dangerous, has a bit of a bad reputation, but it's not because they are underlying bad things. In fact, derivatives are very powerful to help mitigate risk and help share risk and reward across different parties. So derivatives are very important and frankly, a very interesting part of finance, but they are securities. All right, learning objective 2. What is the purpose of all these laws and why do we need them? So I'm sure you remember back in your managerial economics is that there are a few problems when we have a not efficient market. One is information asymmetry. That's a fancy way to say that one party knows something the other doesn't. And because of that, there's an unfair advantage to the party that knows something. So if you're negotiating and you know exactly what's happening with your major contracts and customers, and someone's trying to negotiate with you, say an investor or someone seeking to buy your company, there is information asymmetry, which provides you an advantage. So this is common in the problem, a common problem for private companies because there is all types of information asymmetry. Moral hazard, where one has an advantage personally that can benefit them to the detriment of the other. And finally, principal-agent conflict, which pops its head up all over in business. And this is where the owner and its agent, say an employee to make it easy, has different objectives. And the agent may act in the agent's self-interest, which may run against the interests of the principal or the owner. So these are things inherently difficult in any business, but even more so in private businesses. And how do we counter this? Well, we can look at the risks and how the laws try to mitigate these problems. So one, let's look at individual securities. The legislation, which we already saw, the Securities Act, 1933, this led to some protections like due diligence prior to the issuance of a new security or a secondary issue of new securities from a previously publicly traded company. And also disclosures governing that anything relevant and material, you'll hear that word quite a bit, must be disclosed to investors. Material means that it would, if you knew it, it would change or may change your opinion or in your investment decision. So for example, if the year ends in December 31st and 1 month later you're handed a very negative judgment by the US government. Well, did that event occur before December 31st? The answer is no, it happened in January. Yet the issuance of the report hasn't happened yet. Most audit reports don't come in till 3 or 4 months after year end. So this is an example of a subsequent event. Something after year end in January where it's a $500 million settlement or penalty against your company. Is that material? Yeah, I'd want to know if the company had a debt or an obligation to the U.S. government for $500 million. So that is an example of a disclosure. So anything that would make a difference must be disclosed to all investors, not selective ones, but all of them. Secondly, we'll look at the functioning of the markets themselves, the trading of securities. And this is the Securities Act of 1934, and this is the issuance of the IPO, and then secondary issues, which really means not that is secondary, tertiary, etc. Secondary just means after the first. And so these secondary issuances could be a second stock. And then when you hear of secondary markets, it's previously issued shares. I know this is confusing, so I'll do that one more time. A secondary issuance is a company who issues additional stock, going back to the markets for more money, maybe a couple of years after the IPO. So that's a secondary issuance. A secondary market is where you bought something and then now you're selling it to the market itself. And a good example of a secondary market is eBay, right? If you buy a bicycle and you used it and you don't like the bicycle and you want to sell it, you sell it on eBay. That's an example of a secondary market because you were the primary purchases and now you're reselling it. All right, third is companies offering investments to the public. This is Investment Act of 1940. It dealt with financial intermediaries, investment companies, investment banks, etc. And the Investment Act, Advisors Act of 1940 is for the advisors, the professionals that work in those firms providing advice and consulting services to their clients.